Hello everyone, my name is Nadia. In today's video, we are going to discuss two problems. The first one is just in time and the second one is backflash costing. And now let's just jump into the problem. Champion Company manufactures specialty unique cupboard and is considering to implement a JIT production system in their factory. Based on the consultant appraisal, there are several estimated costs that will be reduced from JIT system production. From this sentence onward, this is the information that we need to fill the relevant items here in the table of the Excels. And the questions is we are required to calculate the net benefit or cost to Champion if it adopts JIT production at the plant. And the second question is what non-financial and qualitative factors should Champion consider when making the decision to adopt JIT production? Alright, here we have a table. The first column is relevant items to list all the relevant costs that exist, such as the annual tooling cost, required rate of return on investment. This is all the information from here from the problem. And the second column is relevant costs under the current production system. And the third column is relevant costs under JIT production system. Alright, so the first one is the annual tooling cost. This is from the first information is the annual additional tooling cost to implement the JIT system would be $200,000. So we can assume that the annual tooling cost in current production system is zero because there is no information. And for the JIT production system is $200,000. And next, moving on to the next sentence. Average inventory would decline by 75% from the current level of $1.5 million. Okay, so when we are going to calculate the cost of inventory, don't forget to also add the percentage of the required rate of return. So we see here in the last sentence, Champion's required rate of return on inventory investment is 12% per year. Therefore, we are going to calculate the 12% here and multiply it with the 1.5 million is the value of the inventory. So in the current production system, we have 12% multiply with the 1.5 million. And for the JIT production system, since it would be declined by 75%, the value is only 25% from the current value. That is why we multiply the 12%, it is the required rate of return, with 25% from the 1.5 million. So we have 12% multiplied with the 375,000. Whoops. And we have 45,000. And moving on is the additional cost to reduce our insurance, space, materials handling, and setup costs, which currently total 400,000 annually, and it would be declined by 30%. So here we can fill the current production system with 400,000, and since it will be declined by 30%, it means that the rest of the value is the 70% from the 400,000 or from the current value. That results in 280,000. And next is about the rework costs. The emphasis on quality inherent in JIT production would reduce rework costs by 20%, and Champion currently incurs 300,000 in annual rework costs. So we can fill this table with 300,000 since it is the current cost of the rework. And by reducing the 20% of rework costs, it means that the cost is only 80% from the current cost, and it results in 240. And last is about the price. So improved product quality under JIT production would enable Champion to raise the additional price of its product by $10 per unit. And Champion usually sells 50,000 units each year. In the current production system, we can fill with zero since there is no incremental revenues, but in the JIT system, the incremental revenues is to multiply the additional price with the units that is sold. That is $10 multiplied with 50,000. Okay, I put the minus here because Our aim is to calculate the incremental cost, and since it is the incremental revenues, it means that it would decrease the costs. And for the sake of the formula, I put minus here. And now we can calculate the total net incremental cost is by summing everything here. So we got 880,000 for relevant costs under current production system, 265,000 for relevant costs under JIT production system. And the annual difference in favor of JIT production is the difference between the current production and the JIT production system. So the conclusion is the annual benefit of Champion Company is 615,000 if implementing the JIT production system. And our second question is the non-financial and qualitative factors that should be considered by Champion when making the decision to adopt JIT production. As we know that just-in-time production system is to produce the goods whenever we have demand from the customer. So we have to make sure many qualitative things. Actually, you can read it here. For example, the possibility of developing and implementing a detailed system for integrating the sequential operations of the manufacturing process. So we know that the direct materials would come to the factory on time. Our next example is to have a standardized production process so it can reduce manufacturing time, or the company has to have the confidence to be able to deliver quality products on time so that the customer satisfactory would not decrease. And that's it for the problem 1, and we are going to move on to the problem 2. Here in problem 2, we are going to discuss about Backflash Costing. Hello Corporation produces Valentine's Day merchandise. It uses JIT production system, which lead to Backflash Costing system with 3 trigger points. The first one is the purchase of direct materials and incurring of conversion costs. Second one is the completion of finished goods, and the last one is sale of finished goods. There are no beginning inventories of materials or finished goods, and no beginning or ending work in process inventories. Halo Corporation produces 25,500 finished units in July 2020 and sold 25,000 units. And the following data are for July 2020. So we have the data for direct materials purchased, direct materials used, conversion costs incurred, and conversion costs allocated. The first question is to prepare summary of journal entries for July with disposing of under or over allocated conversion costs to cost of goods sold. Alright, so the first note that we have to remember when we are doing the backflash costing is we will always record the amount of conversion costs incurred regardless the level of trigger point. So say that we only have 2 trigger points or maybe 1 trigger points. Either way, we will have to record the conversion costs incurred. Alright, so for the number 1, it is a 3 trigger point as we know from the problem. Purchase of direct materials and conversion costs, completion of finished goods, and sale of finished goods. So the first one is to record the purchase of direct materials. That's why in debit we have materials and in process inventory control, and in credit we have accounts payable with the assumption that we are not paying the direct materials with cash. And the amount is from the table here. The direct materials purchased is 2.1. Same with the account payable. Alright, and now we're going to fill the conversion cost. This is to record the conversion cost incurred. And in debit we have conversion cost control, and in credit we have various account. And for the amount, this is already stated in the problem. The conversion cost incurred is 688.5. And same for the credit. Alright, moving on to the second trigger point is to record the cost of finished goods. That is why in debit we have finished goods control, and in the credit side we have materials and of course the conversion costs. And for the amount, we have to be careful because we know that not all the materials are transferred to finished goods. That is why we have the information of the direct materials used here is only 2040. And for the conversion cost, we are not going to use the conversion cost incurred, but the conversion cost allocated here. So this is 714. And for the finished goods control is to sum the materials with the conversion cost. So we have the finished goods control for 2.754. And to the last trigger point is to record the finished goods that is sold. That is why we have cost of goods sold in debit and credit is finished goods control. And remember that we do not sell all the products. The products sold are only 25,000 units, while the products produced are 25,500 units. And that is why here the cost of goods sold is 25,000 per divided with the 25,500 multiplied with the finished goods control. So we only take the 25,000 cost from the finished goods control. And same with the finished goods credited. Actually, it is done until here, but because we are required to record the under allocated or over allocated of the conversion cost, that is why we have one more journal here. It is actually to write off the under or over allocated of conversion cost to the cost of goods sold. So we have conversion cost allocated in debit and conversion cost control in credit, and the cost of goods sold here is in credit. The conversion cost allocated is 714, while the conversion cost control is 688.5. That is why a write-off to the write-off to the cost of goods sold is 25,500. And that's it for number 1. Moving on to the number 2. If there are only 2 trigger points, material purchase and sale of finished goods, prepare summary journal entries for July. So we don't have the second trigger here. But anyways, let's just do the first trigger. It is actually the same with number 1 when we are purchasing the materials. We are using the amount of direct materials purchased here. And also for the credit side. And for the conversion cost, we are using the amount of the conversion cost incurred, that is 688.5. And same for the credit side. And we are skipping the trigger 2 because it is not required. And we're jumping to the third trigger, that is to record the cost of finished goods that is sold. So actually the debit side is still the cost of goods sold, but the difference here is in the credit side. Before, we credited the finished goods control, but here, since we have no account for the finished goods, we are credited the materials and conversion costs. And for this one, for the materials and in-process inventory, we are going to calculate the units that is sold, that is at 25,000, divided with the units produced, that is 25,500, and multiply it with the direct materials used, that is 2040. So we are not using the direct materials purchased because not all of this are converted into finished goods. That is why we're only using the direct materials used. And for the conversion cost, same, we are going to divide it to 25,000, that is a units that's sold, and divide it with 25,500, that is the units produced, multiply it with the conversion cost allocated. And so we get the cost of goods sold by adding the materials with the conversion cost. And the cost of goods sold is 2.7, but if you were asked what is the total manufacturing cost, the answer is to add the direct material used and the conversion cost allocated, that is 2,754. And that's it for number 2, and we're going to move to number 3. In number 3, if there are only 2 trigger points, completion of finished goods and sale of finished goods, prepare summary journal entries for July. So we are skipping the first trigger, but remember the notes here. we will always record the amount of conversion cost incurred. That is why in number 3, we're still going to record the conversion cost. Here we have conversion cost control, that is the 688.5, and same for the various account. And now to the trigger point number 1, or in this case is the first trigger point. It is to record the finished goods. That's why in debit side we have finished goods control, but in the credit side we have accounts payable control and the conversion costs allocated. So we record the accounts payable here because prior to this trigger point, we have not recorded the direct materials yet. That is why we recorded the accounts payable here. And the amount is the same with direct materials used. That is 2040. And for the conversion cost, that is allocated as 714. And for the finished goods is the sum of accounts payable and conversion cost. And for the third trigger is to record the cost of goods sold. In the debit side, we have cost of goods sold, and in the credit side, we have finished goods control. But remember that not all the units produced are sold, so that is why you have to again divide this 25,000 with 25,500, multiply it with the finished goods control here. So the amount of the finished goods that is processed to cost of goods sold is only 2.7. Okay, that's for number 3. And moving on to the last number. If there are only one trigger points, sale of finished goods, prepare summary journal entries for July. We are skipping the first trigger because it is not required, but remember that we have to record the conversion cost incurred. So here we have the conversion cost control in debit and various accounts in credit with the amount of 688,500. And the second trigger is also not required. And moving on to the third trigger, that is to record the cost of finished goods sold. So we have cost of goods sold here in the debit side, and the credit side we have account payable and conversion cost. Actually, the explanation for this account is same with previous one. Why we have account payable here? Because prior to this trigger point, we have not recorded the direct materials yet. That is why we recorded as accounts payable here. And for the amount, again, we will have to divide 25,000 with 25,500 and multiply it with the direct materials used, that is 2040. And in the conversion cost allocated side, 25,000 divided with 25,500, multiply it with the conversion cost allocated, that is 714. And so the cost of goods sold is 2.7 million. And that's it for today's video. Thank you.